If you don't know me, my name is Bradley. I'm one of the advisors here at ARK Financial Planning. Thank you all so much for coming today. This is our first ever event and it's amazing to see the turnout. It is genuinely comes from my heart. Thank you so much for coming. It's so nice to see everyone turning up and supporting us and showing us that we're doing a good job and you like us essentially. So this is the agenda. It's now 10 past, so that's me done. James, you want to? No, I'm joking. The next half an hour will be James from Liontrust talking. I'll introduce James properly in a second. Then we'll go on to Keith from Columbia Threadneedle. There'll then be half an hour, as I mentioned, for you to fire as many questions as you want at the fund managers. I've already got a couple of questions. Thank you for those that have provided them. If you want to quietly give me a slip of paper with a question, you're more than welcome to, and I'll ask it. At the end, there'll be a 10-minute presentation from Claire from Redmond's, talking about wills and lasting powers of attorney and how important they are if you don't already have them set up. And we'll be hoping to finish at 3:45. If you want to shoot off earlier, that is absolutely fine. If you want to stay with us after for a drink, you're more than welcome to do so as well. Just to quickly introduce the entire of ARK Financial Planning. Hopefully you'll recognise one of these people on the left. You've got Phil and Phil, the two founders of ARK Financial Planning. Hopefully you recognise one of those two, or this handsome chap at the bottom. This side of the screen essentially is the people that do all the talking, and this side of the screen essentially is the people that do all the work. So you might not be as familiar with Rebecca, Cara and Zoe, but it's kind of weird because they'll know everything about you. So you just kind of have to kind of work that one out. If you ask them, they'll probably say that I don't fit here. I probably fit in the middle, not because I do both, but because I do neither. So, we're joined today by James Klemster, who's at the back, and Keith, sorry, at the side, and Keith, who's I think he's still through there. Yes. Yeah, thanks, Eddie. Yeah, he's still through there. Keith and James are proper investment fund managers. They work in London. They have very, very busy jobs, and we are so lucky to have two of them in the same room at the same time presenting to you guys. The reason Keith's through there is probably because he's doing about 18 different things and making big decisions. So we'll leave Keith in there and go and grab him when it's his time to shine. We're also joined by Graham. Graham's talking, but hi Graham. And Eddie, who are also really just as in tune with what's happening in the investment world. If you can't grab James and Keith, please grab Graham and Eddie, and they will talk to you to your heart's content about the world of investments and answer any questions you've got if you want a quiet conversation. Just to explain a little bit more about who Liontrust and Columbia Threadneedle are, because I'm conscious you're all invested into different things, you all have different investments, ISAs, pensions, funds, just to kind of position it as best we can for you. Now, there are three sections to the financial advice world. You've got the advisors, us, you've got the investment platform, and then you've got the investment funds. To throw a few names that you might recognise: Elevate, Fidelity, Prudential, Quilter, Fundment. Those are the investment platforms. They look after the administration of your pension, your ISA, your investment, whatever it may be. We've then got the investment funds. So Liontrust, Columbia Threadneedle are the two fund managers here today, but you might be familiar with Quilter, Prudential, 7am. Confusingly, companies like Quilter and Prudential do pensions and they do investment funds. That's fine, some companies do it that way. Liontrust and Liontrust and Columbia Threadneedle, purely are investment fund managers, so they are specialists in their field. You might be thinking, well, why are we not getting presentations from these guys? Why are we only getting it from these guys? Well, I'll explain. The platform is kind of boring. All it does is the administration, the accounting, the reporting, the tax relief and tax charges, and does all that legwork in the background. If we got someone from Fundment or Elevate to come and present, you would be bored to sleep within 5 minutes. Unfortunately, we have to sit through those presentations and work out where your money should go. Luckily, you guys don't have to. The investment funds, that's the sexy part of investment management and financial advice. I appreciate none of you thought I'd describe something as sexy today, but honestly, this is as good as it gets. What the investment fund managers do, crucially, is give you that squiggly line performance that you know and that we talk about at each of your reviews. So this is the exciting fun stuff. This is the spearhead of investment management, of financial advice. Just to really hone in on that point, as you all know, ARK Financial Planning's global headquarters is based where we are now, or just around the corner from here, just outside of Manchester in Oldham. Phil Stevenson coined the name Global Headquarters, and I never used to know why. And then I started working here, and I realised that Phil Stevenson's literally always on holiday, so he needs to know globally where his headquarters is, and that's why he calls it the GHQ. When you look at where each of the companies are based, so your platforms will all be based in the UK. They'll either be based in Scotland, London, some are based in Manchester and whatnot, but they are just administrators working in an office somewhere in the UK. Your investment funds have a global reach. So Keith and James I'm not going to say where they've been, but have likely been to many corners of the world to effectively do their job and to understand what's going on to make the best investment decisions for you. And oh, yeah, there we go. That's the kind of presence they've got. So if they've not got an office out there, they'll have a contact or a colleague or someone working in one of those global offices, helping them or giving them the edge that they need to do as best as they can with your money and make it go in the right direction, essentially. I've done one training session on presenting and making a slide deck. And one of the things I remember was you have to do a theme for the day for the presentation. So me and the marketing team got together yesterday and we decided on pictures of Saddleworth as the theme, which sounded really good. And then I realized you kind of all just live around here and I'm just showing you pictures of places you already know, which sounds less cool now. But say la vie, that's what you get when the marketing team is just me. The reason I put this picture up is because it's picturesque and hopefully you can clearly see what that says, which is this is not financial advice. Everything you see today is purely factual, it's purely information based, and it's just to give you an idea of what goes on behind the scenes. I know you won't, but please don't go and invest £1 million or whatever you've got into one of the companies talked about today. This isn't the purpose of this, it's just to give you an idea and an update. Does that all make sense? Does anybody have any questions before I start? No? I'll pass you over to James Klemster from Liontrust Investment Management. James,
At Liontrust, Graham and myself, we've been doing this for many years in this firm and in previous firms as well, and actually doing meetings like this where we come and meet the end user. And I think it's incredibly important actually to build these sorts of relationships, build this sort of trust, which ultimately really, I don't think you can synthesize it. I don't think you can create it in a sort of in an electronic way as authentically as you can in real life. So we make a big point, and we spend a lot of time actually out of our sort of out of our schedule, making sure we meet people, and we can have the chance to discuss their investments with them. So hopefully this is the first of many, and we'd be delighted to come back and have a similar conversation at some point in the future. Shall I go and stand in the spotlight? Would that help? I feel like who my team, the team I represent, are, and then we'll get into the detail of the presentation. We'll keep it nice and high level. You can't read that, you don't have a chance. That's telling you don't invest, as Brad's already said. So what this slide is meant to be demonstrating is the scale of Liontrust. To give you a flavour for our business, we are a UK domiciled, UK listed investment management firm based in London. We have people all over the country, various geographical locations around the world. We run in our team, in the office in London, we run £22.6 billion between the people in London. And the multi-asset team, which is the team I represent today, we run a short 4 billion of that. So within the business, my colleagues and I are a substantial part of the overall Liontrust offering. That's the multi-asset team there. I'll describe what multi-asset means in a minute. You can see myself, second one in there. I've been doing this for just over 20 years. The head of the team, John Husselby, has been doing it for over 40. I've known John for a very long time, best part of 20 years. I first met him actually 20 years ago, roughly. We've shared clients over the last decade or so, including some not too far from here. And then I joined Liontrust to work with John and the rest of the team back in 2021. So I've been there over 4 years now. And again, you've got how much we run. And I'll give you a little overview in terms of what multi-asset means, and then we'll start talking about what we think is really sort of the nub of the presentation, why you invest, why it pays to be patient, and how we like to think about investing in this massive opportunity set that we have around the world. So multi-asset investing, very simply, multi meaning many, and asset being different things that you can invest in. So if you ever watch, any of the financial programs on TV, you pick up the newspapers, look at the financial pages, or read the Financial Times, or put Bloomberg TV on or anything like that, you'll come across talking about equities, which by that we mean stocks and shares. So investments in a business, where you buy a small slice of a business, you buy a share of that business's profitability, and you have an ownership interest which is proportionate to how many shares you have. So if you have one share in a business, chances are you've got a very tiny ownership, you don't have much influence. But if you have a lot of shares in a business, you have a lot of influence, you get voting rights, and you get the ability ultimately to tell the company what to do. That's why you have different sort of powers as a shareholder compared to people who lend to businesses. We talk about the bond markets, we talk about fixed income, we talk about fixed interest. They're all sort of synonyms for another type of investment, another type of asset class, which is fixed income, which is lending to businesses and governments rather than buying a share of their ownership. Different ways of putting money to work. They have very different risk and return profiles. And because they behave differently in different times, they create what we call diversification. And what diversification is, quite simply, is having different eggs in different baskets. The old sort of the adage, you don't want all your eggs in one basket. What we try and do in the land of multi-asset is not only have eggs in different baskets, but also, if you can, find different types of eggs. You've got an ostrich egg, you've got a quail's egg, and you've got chicken eggs in between. So lots of different componentry spread around the world in a nice diverse way. And the reason you want to do that is quite simply, when you think about the world we live in, which is inherently uncertain, it always is, seems profoundly uncertain at times like these, but it always is uncertain. That's the nature of anything where you're trying to look forward and predict and plan, which is what investment is. We operate in an uncertain world. And so the more you can sort of reduce your sensitivity to any one surprise out there, whether it be a political surprise, whether it be an invasion like we saw Russia invading Ukraine a few years ago, whether it be a spike in inflation that we saw in 2022 as we came out of COVID, whether it be COVID itself, all these sorts of shocks that are an inevitability in life, the less sensitive we can be to any one of these in isolation, the easier the journey is meant to be for you as the end user, and the more comfortable it is for you. Ultimately, you sleep better at night, makes you happy, and also the more likely you are to stay invested. And why that's really important is we'll come to see later, when it comes to investment management, patience really pays. When it comes to investing, sticking around, not running when the going gets tough, which is very difficult, of course, not selling your assets when the going gets tough. And that's part of the role, of course, of your financial advisor as a counselor to you through the difficult times. But if you can allow markets to come to you, it's a bath and not a shower. It's supposed to take time. You're supposed to enjoy it, try and relax, and spend the time doing it rather than treating it as a very sort of short-term thing. We'll come to that in just a moment. So let's start by, getting into why we're here, which sounds like a daft question, but actually it's quite a profound one. We are here to talk about investing. What is investing? Anyone want to have a go at a definition? Okay, well, to paraphrase what the dictionary will tell you, it's putting capital at risk with the expectation of achieving a profit. Right? So the first thing, capital, your money. Putting it at risk in the sense of if you're investing, there is a degree of risk involved in investing. And again, your advisors will be able to help you understand how risky different investments are, with the expectation of achieving a profit. So the expectation is a really important word. It's a dangerous word. It doesn't mean guarantee by any means, of course, in the sense that I expect my kids to say please and thank you. It's an expectation. It doesn't always happen, but most of the time it does. I expect my kids to turn the light off when they leave the room. Most of the time they do, but they don't always. But the point is, expectation is very different from hope. It's very different from gambling, from fluttering, from having a punt. What we're talking about is putting money to work with the expectation of achieving a profit. So what does profit mean? Well, again, in a sense, it's pretty obvious. You get more back than you put in the first place. right? The difference between your initial investment and what you get back, that is meant to be your profit. But there's a bit of a nuance. This is where this slide comes in. Again, it's not the best one to read, and I'm sure you'll get these slides afterwards if you're interested in them. What this is showing is the impact of inflation. This has become far more topical in the last handful of years than it has been for a couple of decades. I've been standing in rooms like this talking about inflation, and Graham knows, talking about inflation for years when inflation was zero, and it was flogging a dead horse in many ways, but even when inflation is low, it is a substantial risk. And the reason is because inflation compounds, and by that we mean it mathematically grows on top of itself year over year in a relentless and quite subtle way. It's like having your pocket picked a little bit every day, taking a fraction of your money away from you, and it reduces your spending power. So what we're showing here is, let's say, it'd be nice, wouldn't it, if you had £100,000 on day zero, and these are years going across to 20 years on the right-hand side. If you did nothing with that money, if you had inflation at 2%, which is showing you this green line here, over 20 years, your buying power of that money would go from being £100,000 today, you could only buy the equivalent of £66,000 worth of stuff in 20 years' time. Then you've got 4% and even 6%. Now, 6% is pretty high historically. 4% historically is actually not that high. It's sort of fairly normal. We've become accustomed to very low levels of inflation, but somewhere between 2 and 4 is about normal. And to give you perhaps the clearer picture here, so this is showing you in 10 years, so halfway through this chart, if you had 2% inflation, the value of your pound, you lose that much there. You lose 18% roughly over 10 years with 2% inflation. And if you have 6% inflation over 10 years, you lose roughly half the value of your pound. So inflation and the impact of inflation is a really subtle but powerful headwind that you have to fly into. It slows you down on the way to whatever your financial goals are, whether it be retirement, whether it be passing money on to the next generation, or whatever it is. Again, that's part of your financial plan. But inflation is enemy number one. Now, the good news when it comes to investment management is capital markets, stock markets, shares, the FTSE, which you've obviously, you'll hear about on the news every day. The FTSE does a really good job of beating inflation over the long run. So what we're showing here across the bottom is inflation, and you can hardly see it.
Sorry, Jim.
Yeah.
It's on page 9 of this booklet.
Yeah, brilliant. Thanks, Bradley. You get, that's one of our sort of public service slides. You can have a look at that in a better format in front of you there. The point being, over the long run, the stock market does a really good job of beating inflation. But to come back to Bradley's point at the start, you get a wiggly line. We like to refer in jargonistic terms, it's volatile, moves around a lot. But over the long run, it does a very good job of beating inflation. So the first point about that then is thinking about patience and investing for the long run, because it really does make a big difference in terms of your wealth creation over the long term. So let me show you. This is 40 years roughly. We've chosen this period because it coincides with John Husselby, the man who runs the team's career. And you've gone from zero, obviously, on day one, 40 years ago. You've had a return just from the UK stock market with no intelligence applied to it whatsoever. You just bunged the money in and left it there without touching it. You've ended up with 2,628% return over that period. And that's despite COVID, it's despite the financial crisis, if you remember that, it's despite the dot-com bubble and all these other events. We've got these sort of market-related events atop in the green. And to provide some more historical context, we've got sort of real-life events on the bottom there in the black. Sort of brings it to life. Don't know if any of you remember, I'm sure lots of you do, Black Monday, the day of the storms and the stock market crash, 19th of October 1987, which is there. And you can hardly see it. That was, at the time, obviously a catastrophic market, bear market over the course of a couple of days. Markets fell about 30% in a couple of days. But because of compounding, since then, the scale of that sort of shrinks relative to what you've seen subsequently. And it's interesting to think, and again, clearly there's no guarantees around this, but if history is any sort of guide, if we fast forward 20 years from now, these big ones, COVID, financial crisis, their scale will drop as well. if you believe in compounding and the ability of numbers to continue growing on themselves through compound growth. So again, it just shows the importance of a time horizon and being patient when it comes to investing. It's easier said than done, and again, that's why we have financial advisors. The next point I think is really worth bearing in mind when it comes to that discipline of staying invested is this chart here. I think that's also in those books somewhere as well. But what this really shows is if you had £10,000, we've gone from 100,000 to just 10,000, apologies for that. We've given you 10,000 this time. Over the same time period, if you just stayed invested that whole time, your 10,000 has gone up to 277,500. So no intelligence applied to that whatsoever, no skill, no diligence. It's just whacking it in the stock market and stepping back and letting it do its thing. If you miss the 10 best days in that period, your return essentially halves. You've gone from a gain of 276,000, because you had 10,000 to start with. You've now ended up with just 141,000. So you've roughly halved your return over that 40-year period. Now, what's really interesting about these 10 best days, they're listed across the bottom. Again, you probably can't read that. The best day in the last 40 years in the UK stock market was the 24th of November 2008, which was, still in the teeth of the financial crisis. A 9% gain. And then another 9% gain, the second best day in the last 40 years, 24th of March 2020. Anyone remember the significance of the 23rd and the 24th of March 2020? Yes, but critically, the 23rd of March was the day we went into lockdown. So the day we went into lockdown, there was no good news to be found anywhere in the world. It was unrelentingly bad news, and the stock market rallied 9%. So the point about this is, if you miss the 10 best days, the impact on your total return is absolutely massive. And the challenge with that is the 10 best days often come very soon after the markets have cratered, and they bounce back very quickly, because a lot of it's driven by sentiment, it's driven by mood, it's driven by emotion, not logic. And so markets fall more than they should, and they rally very quickly, often out the bottom. And so you might be able to time your exit perfectly. Let's see, for example, you could foresee COVID being as big a problem as it ended up being when we first heard about it. You might have timed your exit, you might have sold perfectly. But the chances of having the conviction to jump back in with both feet in the middle of March 2020, when the news flow was unrelentingly bad, I suspect is very likely to be low. I certainly wouldn't have had the courage to do that. So rather than try and jump around, we try and build these portfolios in a way that you can allow yourself the patience and the discipline to see through these kind of events. We're not immune to them by any means. We're not pretending we are, but we build it in a way that gives you a better experience through it. And this just a reminder on this slide here again, what this is showing is the daily returns of markets going back over the same time period. Each one of those dots is the daily return, up or down, and most of them sit clustered between plus or minus 2% roughly. But when you get the good ones, these are the biggest gains and the biggest losses. What you'll see is they tend to come clustered together. The biggest losses tend to happen first, markets panic, and then the biggest gains come fairly shortly afterwards, when people have a moment of sort of reflection, and stock market people participating in the stock market think, actually, it's not as bad as we thought. It's going to be all right. Things aren't sort of falling apart, and they rush back in, and the markets go from an extreme of fear to a return of greed. And they're very dominant and important driving forces in markets. And so the closeness of the bad and the good shouldn't be underestimated. And when the going is tough, and when you read all the newspapers and you hear all the terrible stories in the newspaper, that's the time, if you can, to program yourself to think, okay, that means we're in these zones here, and all else being equal, next come these bits. That's the good times. So, it's easier said than done. We've been through enough cycles in the last 20 years of my career to know it's very tough when you're going through it. But, if you can condition yourself to remember that over the long term, markets have historically gone up, and generally, when the going gets tough, markets start to bounce again. Generally, no guarantees, clearly. But, if you can start to allow yourself to think that way, and part of our job is to help you go through that with the education, with all these sorts of documentation, to remember and remind ourselves that, investing in companies, investing in the markets we invest in is rewarding over the long run, but it can be difficult in the short term. That's basically the same information. I'll show you this very quickly. What this is showing is each year, again, the FTSE, the UK stock market, this is where it ended up each calendar year. So the first thing, hopefully, you can see looking at that, that's obviously a zero return. So you start with what you end up with what you started with. These grey bars, most of them are positive. So again, going back to 1986, roughly 40 years, more often than not, on a calendar year basis, the UK stock market has ended up higher than it started. So you've made money. So that profit part has already sort of started to be ticked. The green dot shows you how bad it got on the way. Most years, at some point, you lost money. You ended up below zero. And then most of the time after that, markets came back and you ended up in a decent place. So again, another way of showing the importance of being patient, and when the going gets tough, keep your conviction, keep your patience, keep your discipline, because generally markets come and help you out on the other side. So very quickly in terms of, and this is, we borrowed this from our colleagues at Columbia Threadneedle. You'll see later on a very similar chart, but we tip our hat to them. Bradley said, you need one of these. It's a great way of describing what goes on inside your funds, and so we now have one. Thanks very much to our friends at Columbia. So if you had £100,000 that ended up in one of our funds, what this is trying to give you is a feeling for what goes on underneath. There's a lot of different componentry going on inside each of these funds. So if you had £100,000, you could see you get £3,500 go into this part called alternatives, which is things like property and infrastructure and commodities. So, oil and potentially gold and bits and pieces. You get £2,000 go into cash. The big slugs, though, go into, you get 35,500. So, roughly a third goes into this thing called fixed income, which is lending to businesses, lending to governments. You don't have an ownership interest. They're simply borrowing from you. And you can see some of it goes to companies. So that's corporate bonds here. Some of it goes to governments. It's a big sort of mix. That's one type of asset class in our multi-asset world. And then on the right-hand side, that's the one you classically think of when you think about investments: shares, stocks, equities, as we call it in the jargon. You have a little slither of ownership. And these are the sorts of areas, the sectors they go into, the types of businesses. So you've got sort of communications, you've got consumer discretionary, consumer staples, your supermarkets and things like that. Energy, that sort of goes without saying what that is. That's oil and gas and bits and pieces. Financials, your banks and your insurance companies. Healthcare, information technology. Obviously you get bits and pieces there. And then if you look through to the next level, actually who the companies are, again, you get that sort of information. But you can see the biggest single company exposure is about 1.9%, so it's broadly diversified. There's lots of different eggs, lots of different baskets, which brings us neatly back to where we started. So I think, if it's right with you, Bradley, I'll probably pause there.
Thank you very much, Jake. Before I release, you can all write down on your piece of paper with a pen the number of times we think Keith is going to refer to Donald Trump. So if he says Donald Trump, the US President, the Donald, Mr. Trump, whatever he says, every time he says that, it's a mark. Zoe has got a pen in her hand ready. She's going to mark down the number of times he says Donald Trump. At the end, we'll ask Zoe how many times he said it. Whoever gets the right answer potentially wins a bottle of wine. If there's more than one person with the same answer, can you all please write down a time you think he's going to say it? It's the first time we think Keith is going to mention Donald Trump. So it might be 1 minute, it might be 2 minutes, it might be 5 minutes. Write it down. Whoever's closest, when you get the right number, whoever's closest gets the right time, wins a bottle of wine. Thank you very much, Keith.
I think that's the first time I've ever been introduced like that before. So, my name's Keith Balmer. I'm Portfolio Manager at Columbia Threadneedle. Not going to talk through anything about funds because we're not allowed to. So please don't ask any questions on that front. Brad's asked me to talk about what's going on in the world.
Keith, stand on the other side.
Under the spotlight.
Yeah, thank you.
There we go.
I was going to say, wax the spots. Brad's asked me to talk about global macro, what's going on in the world and what's going to be affecting prices. My guess is, for everyone else in this room, you're probably going to be listening to try and find out whether I'm going to be saying that equities or stocks or shares are going to be going up or down over the next 12 months. So you can time your next investments. But we're going to see how far that goes. We do have a problem. I heard in the previous presentation some different terms being bandied around. I'm going to try and speak English all the way through. Because we do have a habit in our world of talking completely different language than everyone else. So if I do say a term that you don't understand, put your hand up, don't worry. A lot of people don't understand the stuff, and you shouldn't understand the stuff that we generally talk about. It's our own language, our internal stuff. But please do put your hand up at that stage. The other thing I'm going to be trying to be unequivocally ambiguous. Because it means to say, in 12 months' time, when you have the second one of these, I can be proved right in everything that I've said. So that's what we're going for. I'm going to start off with the US. We're Columbia Threadneedle. You can find out about us. We're a big asset manager. I know Brad wants us to talk about how good and massive we are, but I feel a little bit self-conscious about that sort of stuff. We're big. We've been around for a long time. You might know us more on the Threadneedle side. That's a UK asset manager. I used to work on the F&C, so if you ever remember Foreign and Colonial as a company, I used to work on that side as well. So lots of money, we do lots of things, we do lots of investment, and we look after lots of different types of money. So whether it's investors such as yourselves, whether it's institutions, pension funds, sovereign wealth funds, it's the broad gamut all the way through. So enough of that. We're going to start off on the US, and for each one of these, I've got loads of, normally an economist would stand up here and put a whole load of graphs. I don't want to put a whole load of graphs up here for you. Firstly, you probably won't be able to see it, and secondly, I'll end up going, as you can see from this line, and it won't mean anything to you. So we're going to go with the key people in each one of them. So Donald Trump, Elon Musk, and Jerome Powell is who I'm going to concentrate on in the US. So in the US, what is going on? Well, you've seen a huge amount of volatility. By volatility, I mean that the price of stocks, shares or equities, or fixed income or bonds, same thing, those things have been bouncing around an awful lot. So the value of your investments have been going up and down quite a lot. And it's a lot to do with this gentleman here, because he's decided that he's going to make all the policy in the US. Despite what he tells his voters, the US economy is actually in pretty decent shape. There's nothing particularly wrong with it. It's growing at about 2.4%. Talk about last quarter in a little bit, but really it's growing quite nicely. Most other countries around the world would happily take their growth rates. Their unemployment rate is pretty low. It's somewhere around about 4.1%. It's gone up a little bit. So the unemployment is getting a little bit worse than it was before, but really nothing to worry about. Inflation that everyone was really concerned about before, that was the only thing that people talked about in the last couple of years, well, that's down at 2.4%. So really quite close to that 2% target, and it's falling. So generally, the US economy is in absolutely pretty decent shape. It's not great shape, but it's pretty decent shape. But it's getting a little bit, I use a term I use quite a lot, at the margin. Basically means to say it's not big enough to worry about, but we should be just keep on checking it, keep on looking at it, just see if that continues. Obviously, if that trend continues to get a lot worse, then the US economy will fall over, go into recession, and that's bad for everyone. But we're not there. There's two actual perceived problems. Well, there's two other problems, and actually one of them's perceived and one of them's real. The perceived problem is one that this man has been talking about an awful lot, and that's tariffs, or the problem that he perceives at is effectively trade imbalances. Effectively, Americans are buying more goods from everyone else internationally than everyone else internationally is buying from them. And for him, that's a big problem because it resonates well with the voters, I think, more than anything else. Really, in economic terms, it's not a problem at all. There is no issue with that. But he's decided it is a problem, and so therefore he's decided a trade war. So we've got tariffs going on. I am not going to run through all the different tariffs. We'll be here for the next 30 minutes describing exactly which tariffs have gone on and gone off again. But at the moment, tariffs in the US, well, they started off incredibly high. They were much, much higher than the market was expecting. We personally expected them to be 10% across the board. That was generally where the market was as well. And if you remember, Donald Trump in the Rose Garden, he was up there with his little banners there he was with 20, 30, 40, 50, 60, 54, 35, a whole lot of random numbers, all of them significantly above 10%. The markets reacted quite normally. Nothing particularly wrong with that. If you're going to have those sort of tariffs going through, that is going to impact on companies in terms of their margins, in terms of how much people are going to buy, and so therefore all of those profits for companies is going to be much less. And hence, the share price of those companies should fall. And they did. It also means to say that if everyone spends a lot less, so the consumers spend less, there's going to be less growth in the whole economy, so therefore you'd expect potentially with those sort of level of tariffs that the US was going to get into a recession. And a recession is not good for anyone. So that's why equity markets sold off by about 10%. Now they'd already sold off before that, but that's a different reason. And what's happened since? Well, everyone's heard of TACO now. So Trump always chickens out. TACO, a nasty question, that, very nasty. No one should say anything nasty. Not least Donald Trump himself. So that was a nasty question. Doesn't like that. But what actually happened? Well, he chickened out, as he always does. Big policy, and then rolls it all back. So what we do, if you think about the equity markets or the stock markets, well, before we were worried if you had the high tariffs, you're going to have less profits, which means to say stock market prices should come down or share price should come down. Well, if the tariffs go back, well, what should happen to share prices? They should go back up. And that's exactly what's happened. So if you didn't do any trading over the period, you're absolutely fine. The worst thing would have been to have actually sold out of all of your equity holdings as soon as the news was announced. The 90-day, certainly in the last one, you heard about big moves in single days, where you had a 9% move or 11% move in the S&P on one day when you had that 90-day pause. We've had further developments, which is effectively a court that no one else had ever heard of before, but the trade court in the US saying that actually Trump has overstepped his remit, and he certainly has overstepped his remit, and so therefore most of those tariffs have been illegal. The Supreme Court above that has now said, well, we can't make a judgment on that, but we don't want to just not have them anymore, so we're going to pause. So they're still on at the moment, potentially, but that's still at the reduced rate of the 90 days, which is down to 10%. You still following? So we're jumping all around. With this sort of movement, it's very difficult to know how much profitability, how much profit, how much margin, how much capital expenditure each company is going to be able to do. If you don't know how much the raw goods that you're going to have to buy in from abroad to then run through and build into whatever you make, whatever widget you produce, your capital expenditure goes down. The uncertainty goes up, and hence economic activity goes down. And that's where we are at the moment. So it's all fine, there's no problems. That 10% tariff may or may not stay. On 9th of July, we're going to get to the situation where that 90-day pause disappears. It's coming up relatively soon. But even if it does disappear, I still think we're going to be somewhere around about 10%. China's going to be treated specially, so they're going to have a slightly higher rate, but that's about it. So effectively, what's gone on with Donald Trump is an awful lot of noise without an awful lot of anything useful coming out of it. He has gained some sort of revenue, which is going to offset his deficit, but that's the first problem. And I think that's a perceived problem that the US has. There's a real problem, which is the amount of debt. So to question from the back there in terms of the US debt versus UK, well, it was more referring to UK debt. Well, the US actually has a bit of a bigger problem in terms of the size of the debt and the magnitude of that, and the big, beautiful bill that's going through at the moment, the BBB. Guess who made that name up? So the big, beautiful bill is going to increase spending by another 3% of GDP. Anyone know what the GDP of America is? Roughly 30 trillion. This is a large amount of money that is adding in terms of the deficit. This is huge amounts of money. Now, they are the reserve currency. Sterling used to be, we gave that up. It's very painful when we gave it up. The US is not going to be giving it up anytime soon, regardless of what Donald Trump says. So they are allowed to run big deficits without it being too much of a problem. And actually having big deficits or big piles of debt isn't necessarily a problem either, because central banks can just buy it up. And if you want an example of that, the Japanese central bank at the moment, so the Bank of Japan, owns 50% of all Japanese government debt. So effectively, you put it out there and then the bank just buys it back. Fantastic. So it's not necessarily too much of a problem, but what it does mean to say is if you think about government bonds being an IOU, Now, if you give it to your best mate and you really trust them and you know that they will definitely pay you back, then that's fine. You won't maybe have any rate of interest between you. The higher the risk, the higher the reward that you want to get back for that. And so therefore that means, say, the higher the interest rate or the coupon or the yield that you're going to get from that bond. And that's one of the problems that they've got, is that the US government bond yield has been going up and up and up and up. And Donald Trump has also recognized that that's a problem. And so has that man, Elon Musk. That bromance has now ended, officially ended. Of course, it ends the way everything does nowadays in today's modern world, with a Twitter or an X spat, where they each call each other names, which is obviously the grown-up way of doing it. But Elon was coming. He was hired to cut down the deficit, save a whole lot of money. He said he was going to save 2 trillion, then that was 1 trillion, and now it's about 150 billion, probably a little bit less than that. And then Trump's going to add about 3 trillion onto the debt with just the bill. So what was the point of Doge? Wasn't really any point in it at all. And that's what they've fallen out over. So that's where we are at the moment. And I think that actually is a real issue for the US economy, because they will have to reservice that debt. So if you have a 10-year bond, you've got 10 years, and at the end of 10 years, you've got to pay it back. So you've got to keep on rolling over that debt. And if it gets bigger and bigger, then it takes up larger and larger payments. So that's where we are. So Jerome Powell on the other side, so he is the chair of the Federal Reserve. So he sets monetary policy, or the interest rates in the US, along with his, the monetary policy, no, it's not MPC, the FOMC, the Open Markets Committee. So Jerome Powell is the one setting rates. Trump, once again, I haven't clicked through quickly enough, have I? Still the same slide. Go on, you can do this. There we go. Trump once again tweeted yesterday, because inflation was down again. Cut it rates by 1%. It's not going to happen. They are doing wait and see. They probably should start cutting rates soon. The reason being is that inflation, as I said before, isn't too much of a problem. Unemployment is still fine. So there's no urgent need to do it, but I'd expect them to think about starting to do it. The reason that they haven't done it so far is the uncertainty that Donald Trump has caused through his tariffs. And that's the problem. So they've currently got base rates of 4.5%, slightly ahead of us. By the end of the year, markets are now expecting 2 cuts. So about another 50 basis points to come down. And that will help the economy, and certainly, but Trump will keep on tweeting about it. So that's where on the States. Economy, absolutely fine, getting slightly weaker, but really not too much of a problem. United Kingdom, well, we're in great shape. I tried to be positive. So we got this lot in charge. One could argue whether it's an upgrade on the previous 3 or not. But Keir Balmer, what's going on in the UK? Well, in the UK, all of the metrics are slightly worse than in America. Our growth isn't as good, it's about half, so we're about 1%. We've actually just had a release of GDP, and actually it was negative and actually worse than people were thinking. Don't read too much into that. That's really everyone just front-running all of the tariffs from before. So if you knew that a tariff was going to come in, you try to get your goods in a lot quicker. So there's lots of front-running going on. So don't read too much into the negative GDP result that just came out. But it's still not particularly impressive. 1% isn't really going anywhere, so therefore we need to get more productivity coming through to help out the UK economy. What are we doing? Well, actually, let's go through the other stats. Unemployment is going up slightly, but it's really not too bad. So we're about 4.4%, 4.3%, somewhere around there. That's absolutely fine, no issue, but it is creeping up. And so we've got to be a little bit careful. That increase, a lot of that it's probably got to do with the increases that you saw in national insurance contributions that Rachel Reeves brought in. So we've just got to be a little bit careful, and also things like increasing minimum wage that will also reduce down in terms of employment, and potentially the tariff uncertainty has also not helped. So our exports to the US has fallen by the most in 1 month ever since records began back in 1997. So big impacts going through. Rachel Reeves, she's just done her spending review. What did the spending review do? Who were the winners? Well, the winners were defence, healthcare, and anyone not living in London. So I thought you might enjoy that one. But effectively, that's where it's going. So actually, we're getting more spending. So that should be good news coming through, particularly up here in the north. Better transport links going across. Do I think spending an awful lot more money on defence is a good use of money? Not from an economic perspective. What happens? I spend an awful lot of money on a missile. It's one use only, and then it's gone. I'd much prefer to spend it on things like infrastructure, because if you have good infrastructure, then actually you can have the multiplier effect, and so the economy can do and keep on doing much better on the back of that, as opposed to just having to keep on building more of those. But if you live in Sheffield or Derby or up in Scotland, then you should be happy because you've probably got more jobs coming through just through defence spend. So defence has been pretty good. Who's lost out? Well, the Foreign Office lost out. So basically a lot of the aid that we used to send out to everyone, that budget's been cut by a lot. And there's a whole load of other made up fairy tales about how we're going to make efficiencies and how we're not going to have any asylum hotels and all that sort of stuff coming through. So expect an awful lot of pressure coming up on Rachel Reeves for her budget. OBR's got some pretty, is everyone familiar with the OBR, the Office of Budget Responsibility? They got some pretty rosy or rose-tinted numbers. Is that me out? Am I done? It's not the first time I've been booed off. So there's some pretty rose-tinted views in terms of growth, in terms of productivity. So actually, if we had the same productivity growth that we've had over the past 12 months, or through 2024, which was 0.3%, which is pretty anemic. If we have that again, so if the OBR changes its forecast to say we're going to expect to have that again going forward, there'd be a 35 billion hole in Rachel Reeves' fiscal rules. So personally, I'd expect to see tax rises in the next budget. And actually proper tax rises, as opposed to try and hide it here, there and everywhere. There'll be the try to hide it here, there and everywhere, so it'll be little snippets from there, little snippets from there. If I was I'd put income tax up on additional and higher rate taxpayers. I think that's the easier way. Still fits in the Labour philosophy, probably doesn't fit in with most people in this room, but I think that's sort of where we're going. But as Starmer said recently, we've turned a corner, it's all good news. And so therefore old people can have their winter fuel allowance back. So that's 300 quid going the right way. Andrew Bailey is in a difficult position though, certainly relative to the other central bankers around the world. Andrew Bailey's got a situation where we've still got relatively high inflation and our inflation's going up. So it's not high inflation, it's 3.5%, but it's going up, so it's on the wrong trajectory. I wouldn't worry too much about it, but it does mean to say that you're less likely to see looser monetary policy, i.e. interest rates coming down, than you would if you're having inflation going back the other way towards 2%, so you're less likely to see that. So I think he's got a pretty difficult situation at the moment, and obviously we do have big deficits and we've got more spending coming through, so you've got to be a little bit careful about that, particularly all this stimulative spending coming through. That could once again just increase pressure in terms of inflation. So markets expecting at the moment between 1 and 2 rate cuts from here to the end of the year. We'll see how that goes, but they're definitely in a much harder position than Jerome Powell is and the next one that we're going to come on to. So that's where we are in terms of interest rate policy. Oh, mortgage rates. Everyone always likes to talk about mortgage rates, although looking at the average age in here, you probably already own your houses, so you don't care about mortgage rates anymore. But interestingly, mortgage rates at the front end, yeah, well, this man does, and that man. So at the front end, so short-term interest rates, so the 2-year and 5-year points, they're actually not a lot, but they're definitely cheaper than they were at the start of the year. Interestingly, if you want to get a 10-year, 15, 20-year or 25-year mortgage, they're more expensive. And the reason being is once again coming back to how do you service that debt? We're all expecting now to see inflation to be higher for longer, and having to service that debt that we've got, it's going to become harder and harder. So more debt means to stay harder to service, and interest rates will stay higher. So the long end of the curve that we talk about, so later dated, so 10, 15, 20, 25, 30 years, is actually more expensive now. The front end, because of those interest rates coming through, a bit cheaper. So that's where our mortgage rates, if of interest, I'm going the wrong way. Europe, going to go a little bit quick, so I realise I've run out of all of my time for you. 3 people here, Friedrich Merz, Vladimir Putin, Christine Lagarde. Once again, you can see it should have gone higher or lower when we went through these between the different regions, or better or worse. So Friedrich Merz, new chancellor in Germany. Why have I put him on there? Well, because he's managed to get through the release of the debt brake. They had something in Germany which was the debt brake, sounded very sensible, which was meant to say that they basically had to run balanced budgets, which meant to say that they couldn't spend a huge amount of money, which generally held Germany back relative to everyone else who was just chucking money up in the air for free. They've now released it. Why have they released it? Because effectively Vladimir Putin is not giving up, even though he's Trump's best mate apparently. But Donald hasn't yet been able to, has not been able to convince Vladimir that he should retreat anytime soon, and so therefore the war's still going on, and Trump has basically said you've got to fight that war yourself and increase your spending, and I agree with him on this one, up to levels that you committed to as part of, as a member of NATO. So all of Europe have to increase their spending, so therefore debt break's gone, increased spending, once again on defence. So it's not ideal, but it does mean to say it's relatively stimulative. So you may hear in the newspapers about a company called Rheinmetall. Anyone heard about Rheinmetall? The only reason you've heard about Rheinmetall is basically it's the only defence company in Europe. So interestingly, Trump is forcing more and more people to spend more money on defence, and the biggest defence companies are all in the US. We've got a pretty decent one over here in the UK, BAE, but generally it's mostly US. So Rheinmetall has done incredibly well as a company based out of Germany, defence company. BAE, and this is where actually Keir Starmer's done pretty well, getting much closer ties to Europe, and that will help. That's further good news to come. And hopefully now BAE is included in all of that excess defence spending, so that's other good news for the UK. Do I see an end to the war in Ukraine anytime soon? Not really, unfortunately. I think we're pretty much grinding on for a long time. Obviously Trump doesn't have as much leverage as he thought he was going to have. And Christine Lagarde on the end, she's got one of the easier jobs in terms of central banks. Inflation in the Eurozone is expected to be 1.9% in the next data release. It's currently 2.2, next one's just shortly to come out, 1.9, so beneath the 2% target. They've been cutting rates quite frequently. So they're now down to 2% base rates. So you're not going to see quite as many cuts going through, but they don't need to. Unemployment is down at 6.3%, which sounds high, but that's the lowest it's basically been ever since the start of the Euro, or the creation of the Eurozone. So actually, they're in pretty decent health. Growth, somewhere between US and UK, somewhere around about 1.5%. So nothing to write home about in a particularly great way, but not anything particularly too bad. So Christine Lagarde has probably got one of the easier jobs, and so you can see the ECB putting their feet up for a little while to come, and job is pretty much done. And China, I'd love to have put 3 people up on here, but really the way that they do their democracy is slightly different, and so it's all about Xi Jinping, and so it all depends on exactly what he does. And actually China's in a bit of an issue with their property market. So they everyone found out the great way of making money was to own 1 property, 2 properties, 3 properties, 5 properties. They leveraged all of that up, prices all went up, and then that all collapsed. So they've had a little bit of a property problem. But we've now got the central party starting to spend a bit more money coming through. And they've also proved that Donald Trump has way overstepped the mark in terms of how strong his hand is in terms of the trade war. Why? Because they've got rare earth minerals, and they've got pretty much most of them. And it's not that they've got most of them. They also can, I was going to say enrich. Forgotten the word. Process them. That's the word. Wasn't a hard word, was it? So effectively, they've got somewhere around about 80% of the world's, or 70% of the world's mines that are bringing that out. A lot of that's through Belt and Road. So it means to say it's a really good idea to keep that foreign aid going, keep that soft power going. It really does pay dividends. So they've got a lot of the actual raw materials. They've also got the processing of those, and the ability to then manufacture that into something useful, which is generally into magnets. And not quite the magnets that I assume that you or I remember from early years, just sort of those small little things. Magnets are used in an awful lot of electrical processes nowadays, and so chips and chip manufacturing, stuff like that. So absolutely critical to IT spend going through. So he's got, and he knows he's got, an incredibly strong hand, and that's why Donald is telling everyone that he's doing wonderful trade deals and everything's going down, but actually they're really going down very much in favor of China. So at that point, we've gone around the world very quickly, but I want to make sure, because mine's only one view of this, but we do have 2 minds, and maybe they might be different. So at that point, I'm going to stop.
Thank you very much, Keith.
Where do you want us? I should be on this side then.
Yeah, so...
You've got to match the photos.
Yeah, that's what I do. Do we have results on how many times did Keith say or refer to Donald Trump?
Oof.
20. That's a lot. Did anyone get 20? Put your hand if you got 20.
Only 20.
4 people got 20, right. What was the time? Okay, John, what did you get?
3 minutes.
3 minutes? Oh. 30 seconds? Was it thick or the rain? You're not writing one down now, are you?
No, I'm trying to work out what the time was.
Don't ask.
Oh.
You got one at the back as
I wrote down
well.
all the times that he actually said it.
Oh.
To the
Right.
minute, that's what I've got 20 times.
What time did you get?
I've got 2:43, but all that started.
Well, it
That's
doesn't
when he
matter.
started.
2:43 is a cracking response, even though you put down for the time-wise. That's brilliant.
Did you say 20 as well?
2:45.
Is it 12? Yeah, you do try. Right. Would you like a red or a white bottle of wine?
Both.
A red. Right, I'll put it on the table. There you go. Oh, it's a good one that as well, isn't it? Put it there. Well, I'll tell you what. We should give her a round of applause. Yeah. There are a few questions that we've got up our sleeve to ask them just to kind of get the conversation going. But we've already got 3 questions to start with. So conscious of yours about Rachel Reeves and the spending of the UK. We'll come on to that because I think first of all if we start on the question that Paul asked, then Gary, who's not here today but has asked a question from email. I think he's on holiday. So hi Gary, you've been videoed. We'll go. So Paul will do yours, then we'll do Gary, then we'll come to yours. So the question from Paul is: in situations like pandemics, wars, political insecurity, when markets are volatile, do you, with our clients' money, move those assets into safer options, or do you keep them where they are? James, you want to?
I'll start. Yeah. Certainly, it's possible that we would make those sorts of changes. It obviously, and it's a sort of very weedy answer to say every situation is different and you have to judge each one on its own merits. But certainly, if you look back, situations like the pandemic, where what happened at the start of the pandemic really has a nice kind of linkage back to what Keith was saying. We went from, I think, being relatively ambivalent about it, and then suddenly the range of potential possibilities sort of broadened out massively, and some of them obviously weren't very good, and the majority of them were quite worrisome in one way or another. But we went from having everyone went from having a fairly focused and relaxed worldview to suddenly thinking, well, it could go from anywhere from here to there. And in those kind of situations, obviously the first thing that generally happens is markets sell off, certainly stock markets sell off, because the range of potential outcomes from a business go from being fairly narrow again to fairly broad, and people's response to that tends to be to reduce risk. The way to reduce risk is to sell down, and as you see prices come down in markets. And then our job, and certainly how we at the team and Liontrust would look at it, is to say, well, we've got a lot of new news. There's still a lot of things we don't know, because we're always trying to deal with the future in investments and predicting what's likely to happen. And at the same time, all the things that we can invest in have changed price, generally gone down in price. And so the question for us then is, are these prices that are out there now reflective in a fair way of the risks that are out there, or are they still too expensive and they're not properly reflecting the risks out there, or have they gone too far and they've actually sort of cheapened up and become attractive based on the risks that are out there? And one of the ways that different investment firms will approach these challenges from a different viewpoint is some people look at it and say, well, that's moved enough. I'm happy to sort of start getting excited and start buying into risk today. And other people look at it and say, no, it's still too much unknown and we need to sort of take a step back. So yes, every time markets move in a substantial way, and we've had plenty of examples of that over the last few years, not least even in the first few months of this year, we will look and see whether we think markets have moved over in an over-the-top way, in which case we might sort of get excited and start buying things, or are the risks not properly reflected in prices, in which case we'll look to move towards safer assets. So that is the sort of responses that we go through, but it's very complicated to try and sort of encapsulate it in a short, and not that was a short answer, but in a relatively short answer. But yeah, clearly we do look to make those changes. We don't always make changes, but we certainly are alive to the possibility.
Yeah, I've got a huge amount to add to that because, as James says, every situation is unique. and that situation will always revolve or evolve in a very different way. So frequently there's no playbook to go back to. I do remember back in the pandemic, the general playbook that you had for the pandemic, if you want to look through history, where you've actually got markets trading, was SARS and MERS. I'm not sure if you remember SARS and MERS. Can't even remember what they're called now, but they're respiratory issues.
Syndromes, yeah.
But those two, if you looked at what happened, markets generally move very, very quickly. And during those two periods, markets sold off and then gradually actually came back quite nicely. So if you hadn't traded early enough, you had just been too late, and you'd have been losing money for your clients if you had been trading on the back of that, unless you were buying into more. The pandemic was actually different, because we saw it, and we saw the news, and we saw everything coming through, starting in Italy, and then sort of coming across Europe, and a few numbers, and then bigger numbers and bigger numbers. So what was the playbook? Well, the equity markets did exactly what the equity markets normally did, or do, which is sell off. Playbook was wait. And we did. And we didn't do anything because it was too late to do anything according to the playbook. But then actually, the data just kept on getting worse and worse and worse, and we got nearer to effectively what we actually got to, which was the lockdowns and effectively the complete shutting down of global economies. At that stage, because it was getting worse, then the decision was, this is not like previous times. We shouldn't use history as a guide to the future. We should take risk off the table. So did we actually take risk off the table right at the top? Absolutely not. But less than halfway down, absolutely. And then the really hard one is to know when's the time to get back in. That's the hardest one, because that's when everyone is all pointing the same direction. Everything, all the news is going to get worse. Everything's going to get worse. There's nothing good about it. And that's where you do find a certain type of individual who, I don't know whether you have to block out your emotions. You've just got to be very, very forensic about doing this and going, this is now in a situation where this price is too attractive to just leave. Regardless of all the news, regardless of all the news flow, regardless of the emotions, and we're now buying in. And that's the really hard part. And you don't always get it right. The future is a complete unknown. We don't know I get people asking me what's going to happen in 10 years. I can't tell you what's going to happen tomorrow. I mean, particularly not with, I was going to say, you're not there anymore. You're not there anymore with Donald in the White House, because I mean, at the moment he seems to be doing most of his stuff over the weekend. But effectively, any pronouncement has a really big impact on markets. So yeah, it's really difficult. But that's the idea behind our job is literally to have teams of people who have an intrinsic understanding, will be reading up about as much as possible and trying to make some sort of decision, and then go with that decision. And sometimes it's right, and hopefully that's the majority of the time. And sometimes it's wrong, but hopefully at that point you can realise the mistake, and sometimes come back out.
Thank you, Keith. I like how you opened that by saying, I've not got much to add.
That was a short answer.
Conversely, the China-America tariff war that is on the horizon, that we know is coming, how are you positioning yourselves now, knowing what's coming next? You know, how do you see that playing out? And B, what are you doing to mitigate losses and increase returns as much as possible right now?
I love the way you added in, when you know what's going to happen next.
Yeah. You do, that's your job.
I mean, we went from about a few percent up to 10%, up to 20%, up to 50%, up to, I can't remember the exact stage, up to 145%, down to 30%, plus that's on the 30% is actually on top of the tariffs that were there before. You've got sectoral tariffs to worry about, and Trump has recently said, so we're actually about 55% at the moment, if you take in the ones that Trump put on first time round. I've got no idea where he's going next. But what I can tell you is that 145% tariff rate on China is an embargo. It's not a tariff rate, it's an embargo. That just cuts things off. People do not buy things that are 2.5 times more expensive than they were 1 week ago. That's just that. So in those situations, you can make some sort of educated guess that 145% isn't going to stay. And so therefore that frightening level of tariff, is probably overdone. So effective on the fear and greed scale, so people will always go far too far on both sides. On the fear side, you're probably overdone, so you can be a little bit more relaxed about that. Interestingly, if you look at China's export numbers. Their exports have gone down significantly to the US, but they've dramatically increased to Southeast Asia countries, so Malaysia, to Vietnam, Indonesia, all those sort of places. And so actually, and weirdly, their export numbers have also gone up to the US. So effectively, China's just been able to circumnavigate that, which is why, to be perfectly honest, everyone didn't react quite as badly when it went up to 145, because it was sort of, that's fine. In a way, we kind of knew that that was going to come down. Don't know when, don't know how, but if prices have moved, there was sort of an opportunity to get in there.
Yeah, plenty. At the risk of not trying to fall into Keith's trap. I honestly don't know where to start with this. It is extraordinarily complicated. When it comes to tariffs, we do a weekly video in the team, which is available if you're interested. But I made the point a few months ago when we started talking about tariffs that even steel, just if you just tax steel, which is obviously where they started, it's in pretty much everything you look at in this room. It's going to be in the corners behind the plaster there. It's going to be in the nails. It's going to be in the cutlery. It's going to be in your watch. It's going to be in your phone. It's going to be in that. Yeah. So just tariffs on one thing is unbelievably complicated. In some ways, tariffs on everything is in some ways easier because you just blanket tariff everything. But we're still very much in the early days in terms of what the impact is in terms of consumer confidence and in terms of business confidence. And so, it's likely, and I fully agree with Keith, that we'll likely end up somewhere less extreme than where we're sort of dabbling with presently. It's likely there'll be some sort of tariffs in place. We don't know where they'll end up, but in this intervening period in the last few months, you've had a great amount of uncertainty. And if you're planning investment as a business, you're thinking, do I need to build a warehouse? Do I need to invest in a new production facility? Do I need to buy some new computers even? If you have anything to do with any imports, it must be very difficult to have any sort of decent predictability around your cash flows and your potential additional costs. This is a bit of an aside, but I remember reading in the paper about a firm that makes puzzles, and they're planning their Christmas orders already, and they said they're basically halving their normal Christmas order because they think even if prices went up substantially, they'll probably be able to get away with selling half at much higher. But obviously, they didn't want to do their normal full order because by the time it arrives, it might be subject to massive tariffs. So that's just one tiny example of the amount of uncertainty. And anything about consumers and how important consumers are, us, the people that actually spend the money, account for something like 2/3 of the entire economy. And at the margin, people have got to be thinking, crikey, I don't know if this is going to impact me. And at the margin, that dollar decision here or there, you're going to surely hold on to cash rather than spend it. So the economy in the US, which is different from the stock market, it's different from the shares, but the economy has got to have some sort of uncertainty sat underneath it. And then for us as investors, we're looking at the stock market, we're looking at the price of companies, and we sort of say, is that fully discounted in prices today? It's hard to say with any certainty because there are so much unknowns out there. But it will remain a very fluid, very complicated situation. But the chances are that in the long run, we'll muddle through and things will be all right. Remember that long-term chart that I showed? There's been plenty worse thrown at markets over history, and in the long run, they tend to muddle through and do all right.
One of the best examples of that uncertainty in terms of, say, corporate spending on new facilities, production lines or whatever it is, for me would be Apple. American company, where they make most of their iPhones. Most of their iPhones they've been making in China, but they have been moving their production across to India, so different models have been moved over. Obviously, Trump has gone aggressively against China, and so therefore there was the announcement to say, well, that's fine, we're going to move our production of all iPhones across to India. That would take a little bit of time to do, but that's what we're going to be doing. And that's fine. Actually, the share price went up on the back of that announcement. What did Trump do? Well, Trump went and said, well, if you make your iPhones, and specifically called out Tim Cook and said, if you make your iPhones in India, I'm going to put a 25% tariff on your iPhones. Now, if you think about this wonderful absurdness about this is a US company that's moved their production away from China, which is, I think, most of America's current trade policy is trying to reflect that. They've moved it to India. So a US company's mobile phone is going to be subject to a tariff of 25%. Their biggest rival, Samsung, South Korea, has got a tariff of 10% on their phones coming into the US. So your American company is going to have a tariff of 25%, and your South Korean company, and one of your big champions of American economy, 25%, and Samsung, a South Korean company, will be at 10%. It's complete madness. Complete madness. And that's the world that we're living in at the moment. And there will be some sort of scars on the economy. Don't think enough at the moment to do too much damage, but growth will clearly be a little bit less.
Okay, thank you. I'm conscious we talked a lot about Trump and not a lot about the UK so far, which brings us into Peter's question about what Rachel Reeves is doing. What does a term of Labour look like, I suppose?
Is it Mike or you go? I can't remember now.
I'll start. I mean, I think without trying to be sort of partisan in any sense, I don't think anybody running the country at the moment would have an easy ride. I think it's tough. I don't think the books are particularly well balanced. I think growth is really sort of high enough to sort of pull you out of the mire quickly. And I think what governments need to do is really do policy rather than politics and make long-term plans and bits and pieces. It may just be that that's what we're seeing. And I think that it might be that you have to have the short-term pain for the long-term gain. We certainly need to, focus on generating greater returns in the long run. So in terms of the costs, certainly the most direct cost for governments is obviously what they spend in terms of their budget. And a lot of that gets funded either through taxation, which is obviously one of the ways that they raise money, and that's through us. And Keith already mentioned personal taxation. There's a risk that goes up, of course. If you're spending more, you have to fund it. The other way you fund it is by borrowing. And that's the question about the gilt market or, government bonds. And, the cost of your debt, whether it be a mortgage, whether it be a credit card, or whether it be, trillions of pounds of government bonds, the cost of debt are reliant on two things: how big that debt is and what the interest rate you're paying on it is. And obviously the debt burden has grown substantially over the last sort of 15 years. And recently, the interest rate since 2023, as interest rates moved up substantially, not all Liz Truss's fault, by the way, it was happening anyway around the world as we had that inflationary spike that started in 2022, but it sort of got exacerbated towards the tail end of 2022 as for various reasons in terms of the policies that she and Kwasi Kwarteng brought in. But the point is that interest rate went substantially higher over the course of 2022 and has kind of stayed high ever since. It's all relative. In terms of long-term history, it's roughly in line with where you expect interest rates to be, looking back over sort of decades and certainly hundreds of years. So there's no sort of obvious reason why it collapses back down. But you're in a situation where the amount you borrowed is big, substantially bigger than it's been 20 years ago. And now the interest rate you're paying on it is high as well. So the cost of servicing that debt, paying the interest on it, is a challenge. And it's something that is going to be difficult for governments to navigate.
Sorry, Keith, I'm going to jump in before you did. Just on what you're saying there, Jill's asked a really good question about debt, and obviously you talk about the government side of the debt and how they manage it. We in this room care about that because it's the country, but we care more about what our money is actually doing. And obviously our money is the other side of that fence. We are lending the money to government.
Yes.
Okay. So the question that Jill's got is, what's the benefit of buying debt as opposed to just stocks and shares? Why buy debt? And also, why should we be concerned about how expensive debt is if the banks are always willing to buy it?
Yeah, okay. Well, shall I start and then Keith, you jump in?
You have the first one, I'll have the second one.
Perfect, okay, yeah. What was the first one?
What's the benefit of buying debt?
But yeah, brilliant. So that comes back to the point I made right at the start about not only having eggs in different baskets, but also having different eggs in different baskets. So, the purpose of debt is really to be almost the antithesis of the shares in your portfolio. So shares in your portfolio are all about growth. It's all about getting a share of profitability generated by companies that gets paid back to you as a shareholder, generally through dividends. The point of debt is essentially you lend a fixed amount of money, all else being equal. At the end of that term, like a mortgage in many ways, at the end of that term, you get paid back the principal, which is the amount you lent to them, and on the way you get paid an interest payment. So you don't have the same, what we call upside. You don't have the same ability to make money, in theory, through debt. You're not sharing in profitability. What you're getting is essentially that income payment, which is in theory at least, a much more sort of dependable, sort of low variability source of income. So what's great about it today is two things. So the first thing is your 10-year government bond pays you roughly 4.5%. In these days, what's inflation today? About 2.5%, something like that. So you're getting what we call a real yield. So your income from that bond is higher than your inflation cost. So you're making a positive real yield in excess of inflation on that income that you're getting paid on a monthly or a quarterly basis. And then the other thing it does is we have this notion of yield compression, which sounds very technical and boring, but essentially when people are nervous about stock markets, generally what happens is the yield on these debt instruments goes down, and that means the price goes up. And so it performs a very nice counterbalancing weight to the stocks and the shares in your portfolio. So generally speaking, it doesn't always happen, but generally speaking, when stock markets feel pain, the response to that in debt markets is for yields to go down. So you get paid less in terms of your running yield, but it means the price of those bonds go up. So they perform that yin and yang sort of balancing act in your portfolio.
And the second question was around,
Why should we be concerned that?
they will always,
Well, why should we
people
be
always
concerned
buy it.
if debt's going up?
Yeah, banks always buy it.
Why
Yeah.
are we bothered if the banks are always going to buy it?
Because the banks aren't always going to buy it. And that's the very simple thing. And how do you make something, there's quite an interesting debate at the moment about the government trying to potentially force pension funds to buy certain assets. I'm not sure if you've been following that sort of debate, but it's sort of buying infrastructure, investing in UK assets, in UK infrastructure. That is very much the stick approach. And the stick approach frequently isn't legal, and secondly, it's not something that people want to do, so therefore you're not going to get it much size. It's much better to do the carrot approach, which is how do you make lots of people buy things? You make it really attractive to buy. How do you do that? You make it, you get a really nice rate of return on it for low risk. So coming back to the analogy that we had before, that effectively the size of the debt has been increasing, so you've got to get more and more people to buy more and more of this debt. Well, how do you do that? You've got to have effectively the yields going up. So that coupon or the interest rate that's being paid makes it more attractive versus other things that they could buy. But unfortunately, as per the equation that we just saw, that means that if you have more debt at a higher rate of interest, that's more pain, and so therefore more of our tax pounds need to go in terms of servicing that and less to be spent on other things. So there is definitely a point where one or two things happen. Either people don't buy it, it's not an unending amount to buy, or secondly, it's a situation where it becomes too expensive to happen. And actually, I've just realised the third part is if at the Bank of England, so the Bank of Japan example, in that situation, if all you're doing is the government is putting out bonds and your central bank is buying them, you are putting money into the system. You're effectively creating pounds in this particular case, or creating yen in the case of Japan. You're creating more and more currency, so every single person's pound, which is just, I can exchange this for this many goods. Well, if I make twice as many of them, well, I should really have to use two of them to buy exactly the same good. So therefore, the value of your pound goes down. And clearly, people don't like the value of their home currency and their assets going down. So there's two things. Firstly is how do you actually get the debt away in the first place? If there's more of it, you need to make interest rates higher, which is what's happened. If you look back where interest rates were 5 years ago, pretty much zero. Now, if you look at the long end, so the 30-year end of the curve, you're looking at 5.5%. So things have changed dramatically on that front. And then if it's just central bank's going to buy it, well, why don't you keep doing that? Well, at that point, your pound's just worth an awful lot less. And if you want to see a good example of that, you can just go to most emerging market economies at certain points in their lives, and you find that there's a few out there that Zimbabwe dollar. If anyone remembers the Zimbabwe dollar, you got up to people in wheelbarrows moving their money around just to go and buy a loaf of bread. In the end, they just turn it into the US dollar.
I've actually
got very painful.
I lived in South Africa at the time for my last employer, and I've got a 50 trillion Zimbabwean dollar note at home.
Nice.
50 billion in our office.
You know, the biggest one they did before they dollarized, they did $100 trillion.
Wow.
And I was annoyed that I couldn't find one. They were quite hard to get, but the 50 trillion was the second biggest they did.
Just as a little aside, because I've been doing this sort of experiment up and down through the investment professionals, so financial advisors, because we talk about, I think most people now have got used to sort of millions. We can just about understand what a million is. Everyone sort of now talks about billions in this world, and now we've actually moved on to trillions. I don't think anyone's necessarily got to billions, but we've now moved on to trillions. Just a little thought experiment. How far away from here is 1 million centimeters?
Shout them out. You're welcome. Someone gets it right, you get a bottle of the bottle.
Get a So you have to be, is it plus minus 2 centimeters?
London, we've got London over there. Paris? We're going a bit too far away. Now you put a prize in it, I can't say no and
Rochdale.
Rochdale, there we go, about 10 kilometres away, yeah?
Oh, yeah, no. But you started it for your man, that's
You've got to use the information.
So 1 million centimetres is exactly the same as 10 kilometres. So it's just 10 kilometres away. So that's 1 million centimetres is 10 kilometres. So now you know it's about Rochdale. Well done for a bottle of wine. That was easy, wasn't it? 1 trillion centimetres. Where is 1 trillion centimetres? And I'll give you the range that the financial advisory community, the professionals, have given me across this country. 1 trillion centimetres, I'm not letting him answer the question again. 1 trillion centimetres, the range has been Birmingham, that was from a financial advisor in London, so London to Birmingham, and the sun. And I can tell you the right answer is in between those two. Mars.
You have told Phil before, because I know the answer. So he's got an educated guess there. So.
The actual answer, moon and back 13 times. So not quite as far as Mars. Moon and back 13 times. So 1 million centimetres Rochdale. 1 trillion centimetres, moon and back 13 times. So when people are talking in trillions, these are unbelievably huge numbers. They're just gigantic.
You know how long it would take to count?
Oh, here we go. 1,153 years. I count quicker.
Okay, thank you. Sorry, Peter, we've got a question from Rob and then we'll come to you. Do you want to shout your question out, please?
Yeah, sure. Just a question.
Nice and loud, please. Sorry, thank you.
Just a question about the role of AI in your decision making. Where is it now?
Yeah, I think, so AI is a fascinating topic, and we definitely don't have enough time to cover AI in the depth it probably affords. Currently, where we are personally as a team and as a house, is we don't use a huge amount of AI in our investment decision-making process. And without maybe, I've got no idea what Liontrust do, but I would suggest that at the moment, AI is really, really good for being able to condense a big amount of information into a very digestible way of doing it. So the best way that I can describe, or I've heard it described, is what we're not quite there yet, but we're not a million miles away, is to be able to have an economist, the equivalent of an economist, for every single country or every single region, who'll be able to give you a snapshot of exactly what's going on in that region. And that will only be just scooping up all the information that's already available anyway. We just don't have the time and resources to access and read all of that information from everywhere. But with AI, you've suddenly got the ability to have a really, really good picture in terms of the data that's available and what's going on in each of those different regions. Where I don't think AI's got to yet is the ability to be able to take that information and then make a sensible decision based on that in terms of what you should be doing in the investment side. That doesn't mean to say that it can't make any investment decisions. There are definitely different tools out there and there's different strategies who do use AI as part of their investment strategy. But in terms of at the moment where we are, we're preferring to be able to get enhanced information and then with that better access to information, be able to hopefully make better investment decisions. But that's still from a sort of very human perspective.
Yeah, I mean, I think we're very much, I think all of us are very much in the sort of foothills of our AI journey. I think it's going to be a very important, potentially transformative technology. I don't think we fully appreciate what it will be able to do yet. I think if you liken it to 25 years ago and before the internet sort of kicking off, we're really still in the sort of dial-up phase, aren't we? Using the phone lines and that funny little squealy modem. So, you know, we've got to look, it will likely be extraordinary what it's capable of doing, and we're investing in lots of different software subscriptions. We're trialing several and, you know, seeing what it's capable of. And to come to Keith's point at the moment, what it really seems to do quite well currently is a lot of heavy lifting. Saves us sort of trawling through data and doing those sorts of things. What it ends up doing is sort of anyone's guess really, but given the valuations that these AI-related companies are going for and the amount of money being spent on it, the sky's the limit really in terms of what it could be able to do.
We're just making sure that we've still got a job.
Well, on that, I mean, as someone said to me the other day, it's AI. The thing about AI is not the right question to ask. Is not will AI take my job? It's will the person who does a similar job to me, who's worked out how to use AI better than me, take my job? And that's and so you know, no one I think is sort of got their head in the sand. Everyone's fully aware of the opportunities and the challenges, and I think everyone's trying to embrace it in a sensible, careful, and logical way.
Sorry,
Go on.
just to run on just quickly.
Yeah.
I was thinking of the temper, emotional decision making. That's where we went wrong.
I'm not sure that's guaranteed. I mean, I think if you think about how AI models are trained, they're trained on all available information, and a lot of the information you have out there is essentially, you know, codified emotional responses. So you often find with quantitative approaches, which are sort of mathematical-based approaches, that you know people create these incredible mathematical models, and they're very proud of them. But if you go 2 or 3 layers deep into them, you'd be surprised at how much bias is actually built into these things. And I think AI, you may find certainly if what it does is reflect the sort of total aggregation of everyone's existing view and knowledge and history to this point, I think you might be surprised at how much sort of innate biases find their way in there.
Thank you. Does anyone have any burning questions before we ask our last question? It's going to be another than Peter, and I feel bad he gets 2 questions when 2 people, a lot of people haven't had any. No burning questions. Don't come and find me after and say, I had a burning question. Okay, so Peter asked me 4, I'm going to ask 1. It's a big one. You've not got long to answer it, no pressure.
I'll take this one then.
Yeah, go for it, yeah.
Right, so for a long time, pretty much the entire time most of us have been alive, the world has known globalization. Don't make it here, make it in India, make it in China. It can be done cheaper, you can sell it back. Globalization, globalization, globalization. Now, it feels like globalization has run its course and the world is shifting back towards deglobalization. How effective, how deep are we going to go into deglobalization? In 50 years, are we all going to be buying stuff made in the UK because no one makes it in China anymore?
I went first last time. It's your
All right, I'll start. Yeah, I mean, as with all these things, I think there's a temptation to always look for a sort of, you want absolute clarity in a world of grey. You want sort of black or white. And the likelihood is we're very much in a grey world in the sense of, we have already seen, depending on what data you look at, globalization arguably peaked around about the time of the financial crisis and actually has been on various measures in some form of retrenchment ever since. Having said that, though, it seems, and you can never say with any certainty, I suppose, but it seems extraordinarily unlikely that we're going to turn our back on globalization in a wholesale way. There are clearly areas where governments want to bring things closer to home. Defense is an obvious one, technology an obvious one, and in some ways quite logical. And you've seen things like, the Russian invasion of Ukraine reminds us that, this kind of benign period we've all become accustomed to, that, our sort of generation, if you like, most of our lifetimes, it's not a given. And in which case you need to kind of, have a degree of sort of insurance policies at home. Conversely, the chances of us making very cheap plastic goods and key rings and those sorts of things in an economy where people expect, to have a high standard of living seems pretty unlikely. So I think the likelihood for the next sort of decade or so is somewhere in the middle, where you see a degree of skepticism when it comes to this sort of rampant, unchecked globalization, but I don't think it's likely that it becomes sort of so localized that everything comes back.
Yeah, I'd agree with that. The law of comparative advantage still holds, i.e., if you've got country A that can make something in the most efficient manner and country B that can make good B in the most efficient manner, it's best for both country A and B for them just to make those and then sell their goods across borders. That was the world that we were very much moving towards. If you take, say, Donald Trump, if you're still doing it, perspective from where he is at the moment, we shouldn't be doing that, and we should be moving back to everyone just making our own things. But actually, we've got used to. Why did we do that in the first part? Was because it was cheaper to do it, and so therefore we could afford to buy more things. And as consumers, we've really enjoyed buying more things and bigger things and better things and improved things for less money. I mean, look at electronic goods. I mean, they've been deflationary for the past 40 years. They've just been getting better and better and becoming cheaper and cheaper at the same time. Why is that? It's because we haven't just been making them inside our own little four walls and doing it ourselves. Innovation is much better when there's when you've got more competition going. So there's loads of different things. But when it comes down to the pandemic, that was when everyone realised, certainly in the field of pharmaceuticals, if you think about all of that stuff, when we in the UK were crowing because we'd actually secured the best AstraZeneca contract, and so therefore we were going to get our vaccines and the rest of Europe wasn't, and then Europe said, well, that wasn't fair, they were going to get it, and we were kind of, whoa, hold on, we've signed the contract. At that situation, you can realise that globalisation doesn't work particularly well. And there's going to be those events that happen on a relatively frequent basis, which means to say that you've got to have a certain baseline of stuff that you need to, if you need to have that ability going forward, and you can't just trust your allies, because Trump used to be, or America used to be, a very close ally of ours, I seem to remember, special relationship. It's not the way he's been treating us, or any of his other allies, to be perfectly honest, so therefore you can't rely on that. So you've got to be very careful about those supply chains that you've got, which were just-in-time supply chains from the cheapest people, cheapest countries coming in, and even for critical areas. I mean, I talked about rare earth minerals. Well, China does 87% of the world's processing of that stuff. Well, that's now become a big problem for Trump, because he's realised he can't actually bully people. So if you want to bully people, you've got to be able to do that everything yourself. So deglobalisation, what does that mean to say? It means to say that the product choices we're going to have is going to be non-perfect relative to what we've got now. The price that we're going to be paying for all of our goods is going to be slightly more than we're paying now. So therefore, we're going to be living in a more inefficient world, or a less efficient world. But we're probably going to be slightly more secure to be able to act independently from other people. So completely agree, we're not going to go and completely deglobalize, but there is going to be a certain retrenchment coming back. Oh, he's gone for another. Part B.
Follow up.
I'm really sorry.
We are going to be around for a little bit longer, so.
Yeah, so we've got to be at the car park by 4:30. So that gives us 40 minutes, just over. So are you around for the next half an hour just to...
Sure.
Thank you. So what will happen now, I'll introduce Claire in a second. Keith and James will be around, so Claire will be talking for 5 or 10 minutes. When Claire's finished, you are welcome to come and collar Peter. I'll make sure you're first for asking questions. Speak to them, speak to Eddie and Graham as well, wherever Graham is. They can give you those kind of nuggets of answers to questions you've got. But I really hope you found that Q&A session interesting. I hope you found what these gents have said very interesting. And finally, thank you very, very much for coming, gents.
Thank you.
Wills and lasting powers of attorney are very important documents for protecting not only your wishes but also those of your loved ones, and hope I'm not. So let's start with a will. So a will is a legal document that allows you to say exactly what you want to happen when you die. So who would inherit your house, who would receive your savings, who would look after your children if they're under the age of 18. It also allows you to say who's going to manage your affairs and who's going to see everything through. If you don't have a will, then the law decides for you, and that can lead to outcomes that you never would have chosen. For example, most people might not realise that unmarried partners have no automatic legal right to inherit under the intestacy rules. Even if you've lived together for many years, your partner may not receive anything. And where there's no clear direction, it's not just emotionally hard, it can be financially draining, and it can lead to confusion, delays, and sadly, it can lead to family disputes. So I thought I would address a few misconceptions about making a will. So firstly, we hear often, I'm too young to make a will. Unfortunately, life is unpredictable. Accidents and unexpected events can happen at any time, regardless of age. Having a will ensures that your wishes are known and are respected. Some people say only really wealthy people need to make a will, but it's not just for the rich. It's for anyone who has assets, whether it's a house, savings, investments, or even sentimental belongings, and it allows you to choose who you want for people to inherit those. Some will say everything will automatically go to my spouse or children. But without a will, the law dictates how your estate is distributed, and it may not align with what you want. As I've just mentioned, if you are unmarried, your partner might not receive anything. Writing a will ensures that your loved ones are taken care of. Some people might just say, I can tell my family what I want. Verbal wishes hold no legal weight. Without a valid will, your estate is distributed according to the rules of intestacy, which could lead to unintended consequences. And finally, a will only deals with my financial assets, is what sometimes people think. But if you have children under 18, your will is the only way to appoint guardians, and that's not a decision that you would want to leave to the courts. Blended families. These are also becoming increasingly common, with around 1 in 3 families having children from a previous relationship alongside children with a new partner. In these circumstances, it's crucial to have a will in place that reflects the nuances of these family dynamics. Many parents mistakenly assume that their children will automatically inherit part of their estate. But without a valid will, the intestacy rules will dictate how your estate is distributed, and sometimes it can overlook stepchildren, which will be disinherited. The good news, writing a will is easier than you may think. It doesn't take long and it doesn't have to be expensive. I would also advise people who have made a will to review it regularly, because personal situations can change, circumstances can change. It could be that you get married, the birth of a child or a grandchild, divorce, the death of a beneficiary or an executor, or your financial situation can change. Research suggests that 47% of wills have not been reviewed in more than 5 years. And that means that nearly half of the wills in the UK could be out of date. Okay, moving on to lasting powers of attorney, or people might know them as just LPAs. Unlike a will, an LPA protects you while you are still alive. Life can be unpredictable, and an LPA is there for times when life throws us a curveball. It could be a serious illness, an accident, or an age-related condition such as dementia or Alzheimer's. An LPA is a legal document that allows you to appoint someone you trust, so a family member or a close friend, to make decisions on your behalf when you are unable to do so. There are 2 types of LPA. One that deals with your property and financial affairs, and that gives someone authority to pay your bills, manage your bank accounts, deal with your investments, buy or sell property on your behalf if needed. The second type is health and welfare, and this allows you to appoint someone that you trust to make decisions about your medical treatment, your care, where you may live in the future, your daily routines, when you are unable to make those kinds of decisions. Now you might be thinking, this won't happen to me anytime soon. But capacity is not something that disappears with age. A stroke, a head injury, a sudden illness could leave you unable to make decisions temporarily or permanently at any age. Without an LPA in place, you would need to go through the court of protection to gain control over your affairs. This can be a long, complex and expensive process. But if you have an LPA in place, you get to choose exactly who acts on your behalf, and you can guide them with instructions and preferences on your wishes. So let me bring this home with a story, something that I've seen more than once. A woman in her early 60s, let's call her Jean. She was active, sharp, healthy. She'd not made a will or an LPA because, like many people, she didn't think it was urgent. Unfortunately, she suffered a severe stroke. Overnight, she lost the ability to speak and understand language. Her husband, trying to pay bills and manage her medical care, discovered that he had no legal right over access to her bank accounts or to make decisions about her care. It took him nearly a year to get the legal powers that he needed through the court of protection. By this point, Jean's condition had declined significantly and he was overwhelmed with the stress. This kind of situation is more common than you might think, but it is avoidable with a little preparation. So what can you take from today? Make a will. Update it regularly. Think about your assets, your families, your wishes. Set up both types of LPA. Choose someone you trust and have an honest conversation with them. And perhaps most importantly, don't delay. It's about being prepared and getting your affairs in place now and not when things go wrong. So let me end by saying this. You can't predict your future, but you can prepare for it. Thank you for listening.
Can't tell you how thankful we all are that you've made today possible. The entire business works because of you guys. Thank you so much. If you'd like to join us in the bar, myself, Phil, Rebecca, Zoe, Cara would all like to join you for a drink. Thank you very much.